Good morning, everyone. I hope everyone's doing well. So today we are doing a workshop to cover the basics of VAT. Now, I know a lot of you have had tax previously, so this is to help you just fill in the gaps and to make sure that your foundation is solid so that when you write a test or exam, you can actually pass a question by just applying the basics. There are a few things which are a bit more complicated, but for today, we're just focusing on the basic principles, and that is what would ultimately help you guys get through the course. What I want you guys to do, if you've got any questions, feel free to just type it into the chat function for me, or you can just raise your hand and then put on your mic. And if I'm going too fast and you want me to re-explain something, feel free to stop me. At the end of the day, I want you guys to know what's going on, and if there's anything that you're wondering about, rather ask me. Most of the time, 90% of the other guys also have a similar type of question. So it's better just to ask and clarify than to sit and ponder about it. Okay, so let's just start with what is value-added tax. I know all of you probably already know this, but it is an indirect tax. So it is a tax that is levied on consumption of goods and services. Now, that is what is very important to remember. It is on the consumption of goods and services. If they give you a different scenario and there's no goods and services in the question. So let's take, for example, they give you a company's accounting records and there's a line item depreciation on it. Depreciation is not a goods or a service. It is actually an accounting entry. So no VAT would be levied on that. And because it's an indirect tax, SARS is not levying the tax. The third party, so your supplier and the customer, they are actually the parties that levy and collect the tax and then pay it over to SARS indirectly. Okay. And then remember the VAT rate has changed. So from 1 April 2018, prior to that it was 14%. It is currently 15%. And that is on your standard rated supplies. Remember, if we look at zero rated, it is a 0%. And if it's exempt supply, we actually have no VAT on that. Okay, now let's look at the basic principles. Now your VAT is split into output VAT and input VAT. Now your output VAT is what is raised on the supply of goods and services, and then we go split that between taxable supplies, exempt supplies. Now your taxable supplies can be split into two categories again, your standard rated and your zero rated supplies. Now, when you get a question, you will have to determine whether the information they've provided, does it relate to a taxable supply or exempt supply? If it is an exempt supply, no VAT will be applicable to that. Okay, generally exempt supplies are items where another tax has already been levied, so they don't include it again to tax it twice. So examples would be your salaries. If you earn a salary, it's exempt. Any financial institution, their products that they sell. So for example, the interest that they charge, so either interest received or interest paid would also be exempt supplies. However, a bank's bank charges falls under standard rate because that is a service that they render again. Then if we have taxable supplies, we need to go look at, is it standard rated or zero rated? Now, the easiest way to determine this is you start with zero rated. There is a list in your textbooks under point 2.10 that documents all the zero rated ones. Now your basic things is your basic foods is zero rated. You have any exports and then any transport on land and sea, but not by air. So if you fly with an airplane, that would be standard rated. So you first go look, is it exempt? Is it zero rated? If it doesn't fall into those two categories, it automatically falls into the standard rated category. Okay, so that is generally how we approach it. Now let's quickly look at what else do you need to know for VAT. A person must be registered VAT vendor before they can charge or claim VAT. So if I'm not registered for VAT, I will not be able to claim the input VAT. I will not be required to raise output VAT on the supply of goods and services. Okay, now how do we know if it's input or output? So generally output goes with something that is sold. It can also go with any form of income. Okay, so any revenue that you generate. Whereas goods received, that is payments or expenses that are made, purchases, that is generally linked to your input VAT. Now, the timing of your supply will determine when you will trigger the VAT. Now, the general rule for VAT is the earlier of payment date or invoice date. Okay, so if I've got an invoice before the payment, I would raise the VAT on the invoice date. If the payment occurred before the invoice date, I would actually raise the VAT there. Another thing with the timing of supply that you need to consider is what accounting basis do we use in our business. So we got two accounting bases. We've got the invoice basis and the payment basis. Now the invoice basis is we capture the VAT when we capture the invoice in our system. So what we have to go do at month end, we need to make an adjustment for any payments that was received but no invoice was registered. Whereas with the payment basis, there are specific requirements. Generally, if your amounts are less than 100,000 and you are registered on the payment basis, then you would only pay VAT once you've received the payment. Now that is generally for your smaller type of entities that do not have the cash flow to pay over the VAT based on the invoice basis. Then another thing is you need to know when registration occurs. Now we have two types of registration. We've got compulsory registration. That is if my taxable supplies exceeds 1 million within a 12-month period. Now that 12-month period is a rolling period. It's not aligned to your accounting period. It is for 12 months. Okay, so that is the rule. Now, if I'm a new business, however, I need to go estimate what I think my taxable supplies will be in the next 12 months. And if I expect it will exceed that million mark, then I need to register already at registration. However, if I am unsure, then I don't have to register. So normally what a lot of new businesses do is they will run the business for a few months and see sort of what their income is. And as soon as they realize, okay, we're going to exceed that million mark, then they would only register. Then your voluntary registration, this is now companies which have a lot of capital expenditure and would like to claim the input VAT to reduce the amount of VAT they have to pay over. They are allowed to register even if their turnover is between 50 and a million. Okay, so that's why you would want to register on a voluntary basis. Okay, then returns needs to be submitted in the form of a VAT 201 to SARS. On that form, we generally document your output VAT. We split it between your taxable, your standard rated supplies, zero rated supplies, and then also your exempt supplies. And then we also fill in the input VAT, split it out as well, and then they generally show a net amount, which is your net payable, net refundable, depending on whether your output VAT is more than your input or vice versa. Now that form needs to be submitted by the 25th of each month if you do it a hard copy, otherwise by the end of the month if you do it electronically. Now the frequency of this return will be dependent on what category you fall under. Now the categories are discussed in your textbook. So you've got category A, B, C, D, and E. Now A and B is exactly the same. It is generally less than 30 million and it's every 2 months. Category C is more than 30 million and that is issuing a return every month. Okay, Alzana asked if compulsory and voluntary registration applies to sole proprietors as well. So, Alzana, this registration is not dependent on what type of company you are. So, if you are sole proprietor and you want to register to claim that VAT, you can. Okay, so you don't only have to be a registered business. So you go register as an entity with for VAT and then you can claim it. Okay. Okay, then just getting back to the frequency. So category C is more than 30 million. You can also apply for category C, and with permission you can register for that even if you do not have a 30 million taxable turnover. And then D and E is more your less commonly known ones. So let me just tell you what page of your textbook. So in your textbooks on page 25. So D is every 6 months, and that's generally for your small businesses and your farming activities, and their taxable supplies is less than 1.5 million. And then category E is for your trusts or fixed properties where you only have to do it once a year. Okay, so that's where you basically have the same type of supply every month, but it isn't that big amount. Then you would be registering for category E. Okay, so those things you just need to be aware of. Where they would generally test your knowledge is more on the application in this module, but they can throw in some theory questions which makes up a few marks. So you don't want to lose the marks for these basic principles. Okay, so I've summarized the categories and the tax periods for you guys just as a summary to have this. Okay, now the next question is, when is VAT levied? Now let's look at the rules. So you firstly have to see, who are we dealing with? Are we busy looking at the seller or the buyer? And then we have to see, are they a VAT vendor or not? So if the seller is a vendor and they sell to a vendor, you have to levy VAT. If they sell to a non-VAT vendor, they also have to levy VAT because they themselves are registered for VAT. If they are not a vendor, so they're not registered for VAT, the seller, they would not levy VAT to a vendor or to a non-vendor. So your amount would not include VAT. If I'm the buyer and I am a vendor, so I'm registered for VAT and I buy from a vendor, I can claim the input VAT from whatever I've purchased. Now, if I buy something from a non-vendor, I need to go look specifically, am I buying new goods or am I buying second-hand goods? Now, if I buy new goods, because the non-vendor wouldn't have raised VAT, I can claim no input VAT. But if it's second-hand goods, then there is an assumption that there was input VAT included in that amount. So then you are allowed to claim, we call it the notional input VAT. Then you can claim the input VAT on the second-hand goods. So remember, you can only claim input VAT from a non-vendor if we buy second-hand goods and I am registered for VAT. If I'm not registered for VAT, the buyer as well, then you do not claim any VAT. Okay, so whether you buy from a vendor or non-vendor. Okay, so that is the basic rules. Now let's look at the output VAT, the basics on output. Now, firstly, there's 3 instances when output VAT will be levied. Now, the first one is our supply of goods and services in South Africa by a vendor carrying on a business. Now, it's very important that you see it is in carrying on a business. If I use it for my own personal expenses or for hobbies, that is not carrying on a business, then I will not be allowed, or then I should not be raising the output VAT on it. Okay, because then it's not a supply that relates to my business. Okay, however, there is an exception to this rule. If, for example, originally bought a motor vehicle. Now, a motor vehicle is one of those items where input VAT is denied and you can't claim it. So what the rule says is if I sell that motor vehicle then subsequently, yes, I would have to raise output VAT normally because I am supplying a good, which is the motor vehicle. But because of the fact that I was not allowed to claim the initial input VAT, I do not have to raise the output VAT for that specific item. Okay, so that is the exception to the rule. Then importation of goods by any person into South Africa. So this one doesn't matter whether you're a vendor or non-vendor, you have to pay output VAT if you import goods and services. Now, what is important here is you have to note, is it a BLNS country or not? Now, the BLNS stands for Botswana, Lesotho, Namibia, and Swaziland. Those are the 4 countries. If we import from them, we only levy the 15%, which is our standard rate, on the customs duty value and any import charges. Okay, whereas if I import it from any other country, then I'd add an additional 10% on top of the custom duty value. Okay, so that is the only difference, is that additional 10%. And then you are allowed to claim the VAT input if it is used in making taxable supplies. So if the goods that I have imported, I'm using to make a supply where I would raise VAT on, then I can claim the input VAT on that as well. And then the last one is the supply of imported services to a non-vendor or to a vendor making non-taxable supplies. So if I'm making non-taxable supplies, I am making exempt supplies. Okay, so that's what that means. So if I import services which are either going to sell on to a non-vendor or to someone that's making non-taxable supplies, I also have to raise output VAT on that amount. Okay, now let's quickly look at the time of supply. Like I said earlier, the general rule is the earlier of the invoice date or the payment date. Now, there are some exceptions to the rules, so we're just going to read through them. I see in the textbook that they have scoped a lot of these out for your test or for the semester, but I thought it's good just to mention it if you do deal with this in practice, that you are aware of it. So the exceptions is connected parties. So that is someone in the same entity or business, or you are related, family member, so you're related in some type of form, either by your business or in a personal capacity. Then you would actually raise the VAT when the goods or services are received. If I rent out something, then I would generally use the earlier of the payment due or received date. However, if it's an installment sale, so that is a finance contract, then it would be the earlier of when goods are delivered or consideration is received. And fixed property is only when the registration or the payment occurs. And then the last one is if we use the payment basis. Now, this is one of our accounting bases, and the amount is less than 100,000, then we only raise the VAT on the payment date. Otherwise, we need to go back to the invoice date. Okay, so those are the exceptions. So let's look at a few examples for the time of supply. Now, these examples are in the prescribed textbook. They're on page, let me quickly page to it. They're on page 21, and then the next one will be on page 22. Now, with these time of supply questions, what you have to look at is firstly, what type of accounting basis are we using? Are we using the invoice basis or are we using the payment basis? Okay, now that's the first thing you need to look at. If they do not mention anything in the question, then you go on the assumption that we use the invoice basis and you use the general rule, the earlier of the invoice or the payment. Okay. Now, if we look at the invoice basis, VAT is accounted when an invoice is issued or where the payment is received, whichever occurs first. Okay. Now, in this scenario, we're using the invoice basis. Now, on the 2nd of February, goods were delivered to the client's premises and the invoice was issued on the same day. So on this day, on the 2nd, we've issued the invoice and the payment occurred on the 31st. Now, if we look at the rule, the earlier of the invoice or the payment date, the earlier of the two would be the invoice date, which was the 2nd of February. Okay, so that is when I account for the VAT. Now, why it's important to note this rule is if I have to do a 2-monthly return, for example, and my returns run from Jan to Feb and then March to April. If I do not apply this rule correctly, I would actually account for the VAT in the incorrect month. And then there might be additional penalties levied on it. So this is why this is important. Then on the 29th, a client paid 100,000 for goods delivered on the same date, but the invoice was only issued on the 14th of May. So in this case, the payment was before the invoice date, so it's the 29th. The date when it was delivered, if they give you that type of information, that is irrelevant. You ignore that information and you go on. Now, if we look at the payment basis, so let's look at how the payment basis is different. So the payment basis, on the other hand, we generally do it with the payments. Now, if it's less than 100,000, we do the payment date. If it is more than 100,000, then we go back to the invoice basis, which is the earlier of the invoice or payment. Okay. Now, on the 2nd of February, goods were delivered at a client's premises and the invoice for 15,000. So on the 2nd of Feb, we've had our invoice for 15,000. The goods was issued on the same date. The payment was only received on the 31st. So in this case, because the amount's less than 100,000, your time of supply would be your payment date, which is the 31st of March. So you can see if we've got the wrong accounting basis, we would have accounted for it in the incorrect period as well. Then on the 29th, client paid 50,000 for goods delivered on the same date. The invoice date was the 14th. Now this is exactly the same. We would take it on the payment date, which was the 29th of April, because it's less than 100,000. Now the last one, trading stock was delivered and the invoice was issued on the 19th for 180,000 and the payment only occurred on the 31st of August. But because of the fact that this one is more than 100,000, our time of supply goes back to the earlier of your invoice or your payment. Now in this case, the earlier of the two was the invoice date, which was the 19th of July. So that is the difference between if the accounting basis is invoice basis versus payment basis. Do you guys have any questions on the time of supply and the different accounting bases that we can apply? Is there any questions on the time of supply looking at the two different accounting bases? Okay, if you've got questions, please just stop me. Okay, now if we look at the value of supply, the general rule when we look at how much the amount is that I need to include when I calculate the VAT is you look at the amount of money or the market value of the goods less the VAT. So I take the amount excluding VAT to work out, okay, so it's either the amount of money, so what was the actual consideration paid, or I take the market value and I take out the VAT component. So when we look at market value, we assume VAT is already included in that value. Okay. Now the exceptions to the rules is if it's a connected party, we will always use the market value because with a connected party, the assumption is that the supply is not at an arm's length transaction. So it is not market related. So you received it at a lower price than I would have received it if I got it from a third party. Then vendor deregistration. So this is when I now decide I am deregistering for VAT. Then it will either be at the lower of the cost or the market value at that stage. And then you would raise the VAT based on that amount because it is deemed that you have sold those goods at that day. Installment credit agreement is generally your cash value of the goods. So I take out the finance charges. Now, why do I remove the finance charges? Remember, finance charges is an exempt supply. So that's why it is taken out of the value of the supply. And then change in goods from taxable supplies to exempt or private use. So that is when I've used it for taxable supplies, but now I change the intention of what I'm going to use it for, then it is deemed that I've sold it at market value. Okay, and then I raise the VAT on that amount. Now let's quickly look at zero-rated supplies. Zero-rated supplies, VAT is charged at 0%. If they ask you to explain the difference between zero-rated and exempt, it is important that you state zero-rated VAT is charged at 0%, whereas exempt items, no VAT is charged. Yes, we will not pay any VAT on both of those items, but the one actually is taxed, even though it's at 0%, whereas the other one is not taxed at all. Okay. So that is just very important to note if they ask you the difference between the two. In a test, if you have to do the practical application, what they would sometimes ask you is they will ask you to indicate what type of supply are we busy with. So you need to know the list of what is zero rated, what is exempt, because a lot of students swap these around in a test scenario. So yes, the amounts will be exactly the same. So you would get the point for showing it's a zero tax impact, but you would lose the mark for indicating what type of supply it is. And those marks is generally the difference between a pass and a fail. Now, why do we have zero rated supplies? The fact that we have zero rated supplies means that that supplier or that vendor is allowed to claim the input VAT of everything that he's purchased in creating that supply. Whereas if it's exempt supply, I'm not allowed to claim the input VAT. So that's why it's very important to distinguish between a zero-rated supply and an exempt supply. Now, examples, and you can find this in your textbook under point 2.10, is, for example, petrol, diesel, illuminating paraffin. Now, the exception to the petrol rule is if it's an airplane's petrol, that is actually standard rated. So this petrol refers to your motor vehicles or delivery vehicles, so more your land and sea type of petrol and diesel consumption, as opposed to your flight. Then your basic food stuff like brown bread, milk, fresh fruits and vegetables. Then pilchards that is tinned is also zero rated. However, tuna that is in a tin is standard rated. And then any exports to countries outside of South Africa will be zero rated if it meets the requirements. So that means the goods will be delivered outside of South Africa, and the invoice is then zero rated. So you have a proper tax invoice and then you state that it's zero rated because the goods are delivered outside of the country. If you are not sure that it will be consumed outside of the country, the vendor will have to levy tax at 15%, and then that person that has bought the goods, when they get to the borders, they can actually claim the VAT back when they exit the country with the goods. Okay, so that's the alternative if it hasn't been zero rated from the get-go. Exempt supplies, like I said, no output VAT is levied on exempt supply, but that also means that no input VAT may be claimed. Now, examples of this is, for example, life insurance, interest received and paid. If I'm renting residential accommodation, if you're renting out commercial accommodation, that on the other hand is a standard rated supply. So this is specifically residential accommodation. If it is renting of holiday accommodation, they like to ask you that as well. If it's holiday accommodation, that is also standard rated. It is not an exempt supply. So it's only for residential accommodation, so for private use, that is seen as exempt supply. And then your passenger transport, but only on land and sea. If it is by air, then it is standard rated. Now let's look at a basic example just to show you there's not a lot of information in this question, so it can be any type of supply, and that's what I want to show you. We will look at a more specific one a little later, but let's quickly look at this. So company A and company B are both registered for VAT. Okay, now because they're both registered for VAT, the one has to raise output VAT and the other one can claim it in a purchase. Now, if company A buys goods from company B for 1,150 inclusive of VAT, that means company A has bought the goods, so they can now claim input VAT, whereas company B sold it and they have to raise output VAT on that transaction. Okay. Now, depending on what type of supplies you have, if it is a taxable supply that was being sold, we would raise VAT at 15%. Now, because that amount is inclusive of VAT, you take the 1,150, you multiply it with 15, which is the VAT rate. So what do I want? I want the VAT component, and you divide it by 115. Now, 115 represents a VAT inclusive amount. If it was a VAT exclusive amount, it would have been 100. If it was zero rated supplies, we would have levied it at 0%. So where the 15 was in the previous example, that would have been a 0, which gives us a 0 rand VAT implication. And then the last one is exempt supplies, is also 0 rand because no VAT was physically levied on it. Okay, now as company B sells the goods, they will have to pay the VAT output to SARS. Okay, so company B pays over VAT to SARS, and company A that received the goods, they would have claimed the input VAT from SARS. So they would have received a refund from SARS for that amount. Okay, now what is important in the questions for you guys to note, and this is also where a lot of students go wrong. Make sure that you read properly. Are the amounts inclusive of VAT or are they exclusive of VAT? As you can see on the screen, if it's inclusive, we divide it by 115. Okay, so that's the amount including VAT, or that's representing the amount including VAT. If it is exclusive of VAT, we divide it by 100 because we have not added the VAT component to it. Okay, so it's important. If you get this wrong, you will lose about 60% of the marks in that specific question. Okay, so this is important to note. Now let's see, how do you actually calculate the VAT payable? Now this is your basic formula when you do the calculations. You start out with your output VAT, and then under the output VAT category, you go list all the income or revenue type of items, and then you add them up to get to your total output VAT. Now remember that this column here represents the VAT fraction, so only the VAT portion, not the amount inclusive of VAT, not the amount exclusive of VAT. Students also show that, which then is incorrect. Then you deduct the input VAT from it. So this is based on any purchases, any expenditure that you've incurred, and then add or less adjustments. Now this is any deemed supplies or notional input VAT that you claim, you will adjust it there. Now for your module, the deemed supplies have been excluded, so it would only be the notional input that you would adjust for here, or if you had any prior period errors where you need to adjust for it. And then you work out the VAT payable or VAT refundable. Now, it is payable if my output is bigger than my inputs. It is refundable if the input is bigger than the output. Okay. You get a mark for indicating in a test whether it's payable or refundable. Now, let's say you do this question and you aren't sure whether it's going to be payable or refundable. What I normally tell my students is you do payable slash and then refundable you put in brackets so that it indicates if this amount here is negative, it's refundable. If it is positive, it's payable. And then you would still actually get the mark because you have indicated it. Okay. That's if you do not have time to go back and just scratch out the other one. And then just to recap again, make sure that you only show the VAT and whether the amount is inclusive or exclusive of VAT. That is important. Okay, now let's look at an example of how to do the VAT payable. So this is a basic example with some of the type of transactions you would see in this module. So we said Raka Pty Limited carries on a retail business and is a registered VAT vendor. Okay, so we are registered for VAT, so that means we have to raise output VAT and we can claim input VAT depending on the type of supplies we make. And we tell you that only makes taxable supplies. Okay, so in that case, yes, we know we can claim the input VAT, and we tell you all amounts includes VAT where applicable. Now, if we tell you it includes VAT, all of these amounts are inclusive. If I tell you where applicable, it means if it's standard rated, VAT is included. If it's exempt, it would not have VAT. If it's zero rated, it would have VAT at 0%. So that is what this information here at the end means. Now, what they want you to do is they want you to calculate the VAT payable or receivable for the tax period ending 31st of March. Okay, so what I want you guys to do now is just in the chat function, indicate what type of steps would you have to follow to do this calculation. So to answer the required, what is the steps you would generally follow to get to an answer? Okay, so I'm just going to repeat the question for in case you haven't heard. So if you were busy in a test and you're doing this question, what steps would you do to be able to give me an answer, to tell me what is the VAT payable receivable? So what would you need to calculate to give me an answer? Okay, so Estienne says you have to work out what is classified as output and what is input. So yes, you have to determine your output and your input amounts. That's correct. What else would you need to have a look at? Okay, if there's potential adjustments. Now, in this scenario, because I haven't given you additional information, there wouldn't be adjustments. But if there were additional information, there could potentially be adjustments. So yes, okay, what else? Okay, so Alzan says, firstly, draw a table, then work out all the VAT amounts and state why it is included. Okay, so Alzan, yes. In this scenario, they ask you to calculate the VAT payable receivable. Now, normally in your test paper, as additional notes, we would include that you indicate why something has VAT included or not for additional marks. So in this one, we haven't indicated it, but yes, you would have to state why it's included. So to get to that point, you would have to distinguish in your question between what type of supply is it? Is it a taxable supply? Is it an exempt supply? Because that would impact the VAT amount that you would show in your calculation. Okay, so let's see how do you approach it. So firstly, you have to see if it falls under your output VAT or your input VAT. Okay, so that's step one. Go through the information and determine, is it input VAT? Is it output VAT? Where do I need to put it in my question? Then you have to go look at what type of supply is it. So is it standard rated? Is it 15%? Is it zero rated? Is it 0%? Is it exempt? So is there no VAT on it? Or if it's input VAT, is it potentially prohibited? Am I not allowed to claim the input VAT? So those are the categories you have to go look out for. Then you have to go look in the question, the amounts they've given to you. Is it inclusive or exclusive of VAT? Now in this question, they've told you it's inclusive. So I've already done that step. But you need to be careful. What they love to do sometimes is they would, for example, make most of the amounts inclusive, and then in your additional information, they would give you an example where something is exclusive, where you have to go calculate it differently to see if you read properly. Okay, so also look out for that where they give you both types of information within one question. And then the fourth rule generally is you have to go look at what rule do I need to apply. So we generally apply the general rule if they're not specific with what accounting basis we have. So the earlier of the invoice or the payment date. In the additional information, they would generally give you something like that, and then you need to know whether I need to account for that VAT component in this calculation or not. Okay, so those are the main things you generally need to look out for when doing a VAT payable question. Now, if we look at this question, your output VAT would essentially be these four items here at the top, which relates to a form of income. So these are goods and services that was supplied. Now, if we go through this, is there any exempt items or any zero rated items included in this list here at the top? So if we look at the four income items, are there any items that is zero rated or exempt that you can see? Okay, so Mantikane says sales to Namibia, yes. Sales to Namibia is seen as an export, so that would be a zero-rated sale. Yes, that's correct. Anything else that you see that might potentially be a zero-rated or exempt supply? Okay, so Alzana says entertainment. Okay, so entertainment would not necessarily be an exempt supply, Alzana, but that would fall under your prohibited items, where we are not allowed to claim the input VAT for that specific item. Okay, so that is one of the items as well. Yes. What else do you think you need could potentially not be standard rated in this question? Okay, so interest received, Alzan, that's correct. So interest received is an exempt supply. Salaries and wages is also exempt supply, that's correct. Okay, so let's look at what your answer would look like. Okay, now you can do this in two ways. The suggestion or the way they suggest that you guys do it is to rather do two columns so that you distinguish between the output and input VAT. But you can also do it in one column, but then clearly show what is the total output VAT. So if you want to do it one column, then you would put in here at the bottom total output VAT, and you would sum it, and then here you would say total input VAT, sum it, and then you just do the same calculation at the bottom. Now the reason they suggest 2 columns is just so that it is clear whether it's output VAT or input VAT and you don't mix it up. Okay, so it's just to help you see the different information more clearly. Now, if we look at the example, the sales of goods, because the amount was inclusive of VAT, we would have multiplied with 15. So we want the VAT percentage, which is 15, but the amount was inclusive of VAT. So that's why we divided it by 115 to get to an output VAT of 23,661. Now the income received in advance, the general rule is VAT is levied on the earlier of the payment or invoice date. Now, because they haven't given you further information, you could assume in this case that this was a payment made in advance before the invoice because it was received in advance. So we would have taxed it in that month as well. Okay. And also raise the output VAT. Then interest received is an exempt supply, sales to Namibia zero rated supplies. Then we get to the input VAT. Salaries and wages, no VAT, so it's excluded from a definition of an enterprise. Bank charges is a service that is rendered by a bank, so that's why it's got VAT. So that is not an exempt supply. This is a standard rated supply. Water and electricity is standard rated supply. If you see rates and property in a question, that is an exempt supply. Okay. They generally give you the water and electricity and property rates as one amount, and then you have to go split it out when you do a question like this, when we get to more complex stuff. Then purchases, standard rated. Now entertainment, this is input VAT is denied. Now this entertainment can be to your customer. It can also be anything that you give to your staff. So any form of entertainment will be, the input VAT will be denied. Okay. And then purchase of a delivery vehicle. So if it's a delivery vehicle, you can claim the input VAT. But if it's a motor vehicle, on the other hand, then input VAT would be denied. Okay. And then the last step, and this step students tend to forget, and you get 2 marks for this. So the first thing you have to say whether it's payable or refundable. Now in this case, because the output is more than the input, it is payable. And then you deduct the input from the output amount to get a net amount of 12,622. Okay, and that is how you work out the net VAT payable. Okay, do you guys have any questions so far? Are you guys still okay? Can you just give me a thumbs up, smiley face, frowny face, so I can just see it? Okay, so it seems all of you are still okay for now. Okay, now let's look at the basics of input VAT. Now the basics of input VAT is the VAT that you incurred. So when you purchase the goods or services, VAT was included in that amount because the other vendor had to include it, as well as the VAT on importation of goods that you have to pay over. Now the other type of VAT is the deemed input tax on the acquisition of second-hand goods by a vendor. And you look at the lower of the cost or the market value in that case. So in some of the questions you will see, they will tell you that we've purchased new goods, we've purchased second-hand goods. When you see second-hand goods, a little light needs to go off. Will it relate to input tax, the deemed input tax that I need to go look at? And have they given me both the cost and the market value? And then I have to go look at which one is the lower of the two and then work out the VAT amount. Okay, and input tax is only deductible to the extent that it relates to making taxable supplies. So it must be for taxable supplies. If it's for exempt supplies, we will not be allowed to claim that input VAT. So let's say they give you a question where they say 80% of what they make is taxable supplies, 20% is exempt supplies. Then you would apportion that input VAT to 80% will be claimable and 20% will not be claimable. And you need to have a valid tax invoice. Okay. So in your textbooks, they do explain what a valid tax invoice is. So it has the details of your buyer as well as your seller, both VAT registration number. It needs to indicate invoice. Previously, it had to say it's a tax invoice, but they do accept the invoice as well. It needs to show the VAT amount clearly, and it has to distinguish the items as well on the invoice. Okay, so I'm just going to talk about non-allowable items, and then we're going to take a 10-minute break and then continue after that. So there's certain non-allowable items. Now, these are items where input VAT is not allowed, so you can't claim it. SARS will reject that claim. So the 3 examples is entertainment expenditure. Now, that relates to your clients or to your staff. So in a question, if they tell you they bought a kettle for the canteen, or they bought a kettle for the staff kitchen, that is viewed as entertainment for VAT purposes, and input is denied. However, if I buy a kettle for a buffet area where I actually sell breakfast to customers, that would actually be allowed. So I would be able to claim the input VAT. Then passenger vehicles, so that is a vehicle which can only fit 2 to 20 people. There are exceptions to this rules, but generally in your scenarios, motor vehicles, input will be denied. They will tell you specifically if it's a delivery vehicle or if it is, for example, an Uber company that has applied to be able to claim the input VAT. That would be noted in your question. And then club fee and subscription fees are denied. The exception to this rule is any professional subscription fees. For example, if you have to pay your fee to belong to the law society, to be a registered chartered accountant, to be an accountant, those professional fees, you can actually claim the input VAT. Okay, so we're going to take a 10-minute break. If you guys can be back 11:02, then we will continue. If you've got any questions, you are welcome to just pop them in the chat function for me. But otherwise, I'll see you in 10 minutes.